What's the difference between a fixed rate and a variable rate? A fixed means that you lock in a rate for the next 2, 3, 5 years. A variable rate means you actually get a discount from what we call mortgage prime. And if mortgage prime goes up and down, your rate actually goes up and down. So for example, today, mortgage prime might be 4.95%. If the Bank of Canada lowers the overnight lending rate by 0.25%, your mortgage prime would likely drop, and thus your rate would drop. So if you choose a fixed rate, you're kind of betting that rates will either stay the same or go up, or maybe you really just value stability and not having to worry about your rate changing. If you choose a variable rate, you're probably betting that rates will go down over the next couple of years, and you want to take advantage of that. And maybe you're okay with making a little bit of a bet there that rates will go down and that your payment will probably go down. But you're also taking on the risk that your rates might go up and your payment might go up as well. So how's the rate market right now? So generally put, fixed rates are going down, but they're volatile. So they're going a little bit up, a little bit down, but generally down. Variable rates are dropping. They've dropped, 2.5% over the last 12 months. However, the discounts clients are getting are shrinking. So if you want to get a variable rate, I would lock it in as soon as possible. When you're considering fixed versus variable, another thing to consider is the penalty that you could possibly have in the future. So first of all, you only get charged a penalty if you actually break your mortgage term. Now, lenders typically always charge a penalty. You could have what we call an open mortgage without a penalty, but the rate is typically way higher and a lot of times not worth it. So if you have a penalty, there could be two different types of penalties. First of all, you could have a 3 months interest penalty or an interest rate differential. Okay? Now, if you choose a variable rate mortgage, you always get the 3 months interest penalty. The 3 months interest penalty is typically the smaller of the two penalties. However, if you choose a fixed rate, you would either be charged an interest rate differential or the 3 months interest penalty, whichever is greater is the one you get charged. Now, to know if your fixed is a 3 months interest or interest rate differential, it's very much determined by the current rate market. So let's say you got your mortgage 2 years ago and your rate is higher than today's market, you probably have an interest rate differential penalty, because if the bank or lender has to re-lend the money out, they have to lend it out at a lower rate. So they make up the difference by charging you a higher penalty. So choosing what type of term you get because of your future possible penalties is also important. So what's an interest rate differential penalty? So if you have a fixed rate mortgage and you're looking to break your current term, you could be charged this type of penalty. So let's say, for example, your mortgage is at a 7% rate and the current rate for mortgages is at a 5%. The difference is 2%. If the lender was to resell the money that you borrowed at 5%, it's a lower rate than they currently have it lent to you at. So they charge you the difference in rate to make up for that kind of loss.